attachments to that and minutes of that meeting where we took that to the board or not yet.
So that won't be something
So
that.
that'll be something I will have to notify.
Okay.
Yeah, what about minutes from whatever it was, August 14th would have been done by now. Maybe tomorrow? Tomorrow's good. Yeah, not done.
Here's another question for you,
Yes.
since you are all knowing. My tour of duty in Scorpion Land
Yeah.
will be ending.
Oh, why?
Uh,
Just having too much fun?
I told the principal that they had dropped from like 1,400 to 900 and some students.
Whoa.
Yeah, and so she lost allocations,
Yeah.
and then they were just forced to take me because of the overage process. So I told her that me teaching personal finance to children at the 3rd grade level with reading and math is a waste of the taxpayers' money.
Okay.
And that she would be better off to use that allocation to have somebody fix the computers, because they don't, computers, it's for tech schools, supposedly, and then the computers don't all work. They lost their tech person in the allocation. So I said I'll take a breather. So I won't be there next semester. I talked to my wonderful HR lady, Miss Mao.
Oh, yeah, Sarah's good.
Good. Far better than good, Chairman.
Okay, sorry.
Far better than good. I mean, we're talking championship with her.
Yes, okay. Yeah.
So anyway,
Would you work?
she told me the different paths
Okay.
to follow. If I wind up out on the street, done, and retire and take the PERS
Right.
and keep the insurance,
Right, life insurance?
then I would still be under your
Yes.
umbrella here?
Yes,
Or
you
would
would.
you want me to just
No.
hit the streets?
No, we'll never let you leave. You can check out, you can never leave.
Okay.
Yeah,
Wanted to
no,
check
as
on
long
that.
as, yeah, if you're getting life insurance from us, you would still qualify to be on this.
I would have them do that, with her. If
So
it
am I.
turns out that there's another lady, Wanda Washington, I
Yeah.
spoke briefly with her.
Yeah.
She said she's gonna, muscle around and
Okay.
talk strategies. And
Okay.
then, my wife said, retired, she wants to go
Because
travel.
you've got 5 years in, right?
Yeah, 13,
13. Wow. 13 working for the district?
actually 15, because
I didn't know that.
I had 2 years as a substitute, because I said no sense trying to be a real teacher if I don't like young people. So I said I'll substitute. So I did trainer after school program.
Thomas, how do I hit record on
And
here?
then,
Oh, you did? Okay, great.
I set the record.
Fran, can you hear us?
No, I can't. I heard that.
Okay. We just want to make sure we have vocals good.
Yeah, that's good.
Over. Okay, good afternoon. I hereby call to order the other Post-Employment Benefit Trustees Committee. It is a little past 3:30. Dawn, would you like to take roll?
Present.
Fran McGregor,
Present.
Mary Lamont,
Present.
Mark Mathers.
Present. All right. Our next item is public comment. Anyone wanting to speak at this time can approach the podium and give public comment. Yeah. Okay, seeing none, we will move on to section 2 of the agenda. And the first item is agenda item 2.01, approval of the minutes for the OPEB Trustees Committee meeting on September 20th, 2023. Were there any changes or corrections to the minutes anybody needed to make? Okay, seeing none, I will take public comment at this time. Any public comment on this item? Seeing none, I will take now a motion to approve those minutes.
Jeff Kirst, motion to approve the minutes from our last meeting.
Take a second.
Mary Lamont, second.
Okay, any further discussion? Seeing none, all those in favor say aye. Aye. Nay?
Aye.
Seeing no nays, motion approved unanimously. We will then move on to agenda item 2.02, which is a review of our unaudited financial statements for the first quarter of fiscal year 24. This is for information only. Mindy, would you like to lead us through that?
Okay, thank you. Mindy Kaplan for the record. I'm looking at the comparative statement of net position here, and you can see assets, cash is still lower than it's been, but we expected that. And then the RBIF participation units is on there. We can go through the detail on the third page, but it is higher than we were at this time last year. If you switch over to page 2, you can see we're, with our unrealized gain or loss, we're at a negative $1,982,000 change in net position for through the first quarter, which is actually better than this time last year. The realized gain or loss, you can see, is better this quarter than it was last quarter, 2.2 million. So we're making up some ground there. And then I'll switch to the third page, which is the actual RBIF account. You can see those numbers are coming from the RBIF account with the realized gain and loss. The change in that fund is a decrease of $2.4 million, mainly, in the unrealized appreciation, the change in that, so that's not realized. So our net assets at the end of the period are $79,144,000 in that RBIF account. So, is there any questions? Okay, thank you.
Okay. That brings us to agenda item 2.03. In this item, we would have requested or would have considered the district's request to authorize the transfer of funds from the trust fund for reimbursement of retiree health insurance cost. However, there are a number of items we need to accompany that request, including the minutes of the board meeting where we took the request to the board to. Those minutes are not yet ready, so we will, that item's been pulled. We won't discuss agenda item 2.03. That'll have to wait till next meeting. Okay. That then brings us to agenda item 2.04, again, another informational item. In your packet, you should find the annual financial report, i.e. the audited financial statements for the Retirement Benefits Investment Fund, which is, of course, managed by Nevada PERS. Again, this is where we have the vast bulk of our money. These are their annual financial statements. I guess I would point out to you on page 5 that this is the auditor's opinion on the financial statements prepared by staff, and the bottom line to this is it is a clean opinion. The external auditor has given their opinion that these financial statements do present fairly in all material respects the financial position of the RBIF as of June 30th. So, got a clean opinion, which you always want to see. Then I guess next page I might kind of have you look at or focus on is page 9. And that shows you the statement of net position and the changes in net position. And the net position did increase significantly by $87.5 million in fiscal year 2023. There were actually net withdrawals out of the trust by participating agencies. They contributed $12 million, but withdrew $14.7. But there was net investment income of $90.3 million. So again, that's on page 9. As we've talked before, the fund generated a return for last fiscal year of 12.9%. So very, very strong year that exceeded the assumed rate of return. And then, not sure if you had a chance to look at the notes, but that goes through required disclosures for investments held by the trust. On page 14, you can see the target asset allocation between U.S. stocks, international stocks, and U.S. bonds, which, RBIF is pretty good about holding to, clinging to. And then the last page, page 18, provides a listing of the participating agencies in RBIF. And so you can see right there, we're at the top of the list, have the third largest assets held among agencies. We had $81.6 million as of June 30th. You can see Washoe County has $353 million. And then Clark County has $207 million. So we're kind of the 3 biggest agencies by far that invest in RBIF. Just thought, kind of interesting to see. So, as you can see, kind of the fund's working the way it should. We contributed a little under $21 million but due to appreciation of our investments, we have 81.6, and you can see kind of similar story for the other agencies in the portfolio that, you know, there's been really good appreciation of those assets, of those contributions over time. So, of course, naturally, we did not put this together, but we're happy to try to answer any questions you may have on this fund. Again, this fund was authorized in statute back in 2007, and its really sole purpose is to hold and invest agencies' OPEB assets. So it's a kind of single-purpose agency, lets us get exposure to the stock market versus our other funds that we hold here in the district where we're contained to fixed income. Any questions on those financials?
Jeff Kirst, one or two questions. On the contributions, it's net contributions. I know we take money out and we put money in. Is this the difference between all those, or is this everything that has ever been?
No, we've contributed more than 21 million, so this would be net contributions, our gross contributions less any withdrawals we made over that period of time.
Thank you.
In and out of RBIF, yeah.
And then another question on page 8, when I was going over the different people who are, or entities that are part of this fund, it says that the monies received by the fund from participating trusts are not held in a fiduciary capacity. What would that mean?
Yeah, that is an interesting statement. I will have to ask per staff about that statement because that does not make a lot of sense to me.
It didn't to me either. That I will rely on you to ask the question of
Okay.
someone who can answer.
Okay, they're investing our money, so I would think they would be a fiduciary, right? I will ask them about that statement in their MD&A. That's their own wording. That's not the auditor's wording. That's their own wording. So I'll ask what the explanation for that. Good question. Okay. Any other questions? Okay. All right. Again, that was for discussion only. So the next item, again, is for discussion only. Item 2.05, this is the investment report for RBIF. If you go to page 2, the page with the pie chart in the bottom right, you can see in the first column, wasn't the greatest quarter of all time. Net return of negative 3%, and most of that, of course, was a function of the stock market, where we saw between July 1 and September 30th a dip. It continued to dip into October, but since then it's rebounded above where it started in July, so we'll see a nice positive return next report through the first half of the fiscal year. Bonds also had a negative return, but that should reverse as well. That's just a function of yields in the bond market rising, and so our investments lose value when that happens. But we've since seen yields come down as expectations about monetary policy kind of fluctuate back and forth. So, you know, that's the way it goes, up and down a little bit. And in the next page, again, this is I know kind of a funny little chart, but it compares our performance to a peer group, a peer universe of mid-sized public funds, and this is one of those few times when our return of minus 3% actually was below the median of other entities. Usually we're above median. This quarter we were below median. So we'll have to see how next quarter looks. No, they only lost, quote unquote, 2.4%. We lost 3%. Yeah, these are negative numbers. But you can see that's not generally the case. Okay, any questions? Okay, on we go to, now you're gonna get out of my comfort zone. Agenda item 2.06, which is our actuarial valuation prepared by Gallagher. Again, annual report. This quantifies on an actuarial basis the value of our net OPEB liability. This goes into our own financial statements for the district. So we do have to do this annually. Mindy, I was going to take a shot at going through this unless you had prepared.
If you would, please.
Okay. So on page 1, the executive summary, you can see there in that table 2/3 of the way down, that tells us kind of where we're at. So you can see the total OPEB liability, not including assets, but just the liability of future payments at the BOY means beginning of year, was $159.7 million. And then at the end of the year, it had decreased to $147.8 million. So, and we'll talk about why in a second. Again, we held $81.9 million in assets and investments. And so we see a net OPEB liability of $65.9 million. So good trend. Part of the reason for that is explained on page 2. It has to do with actual changes in actuarial assumptions. And the biggest change was the discount rate that future liabilities are discounted by increased from 4.65 to 5.10%. And that's really a function of the bond market. There's a calculation that looks at bond yields, and because bond yields have risen, the discount rate also rose. So kind of just a mathematical actuarial calculation here more than anything else. And there were other assumption changes as well. This is a pretty darn technical report. And there are tables here that document their assumptions. Page 9, for example, they document their healthcare cost trend rate, i.e. what they expect healthcare costs to rise by annually. Again, they're actuaries, so they're pulling information from a number of entities to calculate that. Try not to fall asleep here. This is an actuarial report, so that's understandable. I know, it's riveting. Exhibit 2, after page 17, again gives you a little bit better breakdown of how things changed between the start of the year and the end of the year. So the top line is the start of the year, so you can see that net OPEB liability of $159.7 million. We had $75.6 million in assets. So we had net OPEB liability $84 million, and then at the bottom of that table you can see our OPEB liability by the end of the year. And in between there it shows you kind of the different changes in assumptions or costs that get you there. We certainly could bring in our actuary to present this in more depth if you like, but again, it's just proving out, again, our total OPEB liability and our net OPEB liability. So our net OPEB liability decreased by almost $20 million. But it'll reverse again if the bond yields fall and our discount rate goes down. So it's, it's a kind of just a more or less a mathematical calculation of our liabilities less assets. Mindy, was there anything you wanted to add? Okay. Exhibit 6, just to show, gives you sensitivities, different sensitivities, and and what our net OPEB liability would be with, you know, plus or minus 1% changes. And it's broken out by the three, well, no, let me see. Yeah, it's broken out between the three types of plans. So anyhow, you can see how those numbers can fluctuate depending on actuarial assumptions. And then the exhibits that follow just kind of give you historical information there. So, not being an actuary, that's the best I can do here to explain some of these numbers. But if you have any questions, I'll try to answer them, or like I say, if you really wanted to get into this report, we could bring in our actuary Gallagher to present next meeting. I just didn't want to do that if you didn't have any questions.
Jeff Kirst, question on the census summary page.
Where's that?
That is page 14.
Okay.
When it says in the middle there, active employees, are those still people who work for the school district, or
Yes.
so they are still teaching or doing other things?
Yeah,
But-
and yes, they're not eligible for the health care benefits, but they would be eligible to receive what an actuary calculates to be the implicit subsidy on life insurance or medical premiums.
Thank you.
Yeah, and we'll get into that in the next item.
Okay.
Yeah. So it's a little misleading in a way, but I'll go into that in the next item if you can bear with me for a second. Fran, Mary, any questions? Okay, you stayed awake, so that's good. That's good, that's good. Everyone's awake still. Okay. All right, so that brings us to item 2.07. And I've kind of hovered around this question or issue before, but let me walk you through kind of what we did here. So the first item I'd ask you to look at is the table with a bunch of numbers on it. Yep. Mr. Kirst, it looks like it's the last attachment. It's not in the actuarial report, it's the very last attachment in your packet. Yep. So what I asked the actuary to do was to, right, they've quantified costs, but we got different kinds of costs that are considered other post-employment benefits. So I asked them first to break out our costs by the type of costs that they calculate, and then give me an annual projection or estimate of costs for the next 50 years, basically. So on the left side of the table, and then you see there's two numbers, two sets of numbers, and then there's a subtotal. So you with me so far? Those are what I consider our hard costs. What we actually are paying outside entities, whether it's Anthem for healthcare or the state OPEB program for their subsidies. So you see the OPEB payments there, you see the medical subsidy payments there. Because if you're not in OPEB and you qualify under our collective bargaining agreement, you get a different kind of subsidy. You're either getting a OPEB subsidy or a different, a subsidy based on the premiums you pay. And so you can see for each of those two payments, it starts around 2.8 million and then declines every year, right? Until you get to 2072, and then there's hardly any costs at all. So why is that? Because this is a closed system. And we already know exactly who qualifies for these benefits. They already would have needed to retire and left the district. And not to be morbid, but these people will pass away, right? So that's why you see these costs decline over time as people pass away, okay? So The subtotal of those, what I would call hard costs, that this entity exists to fund, is $116 million. Does that make sense? And these are undiscounted numbers, by the way. These are their estimate before the discount rate is applied. So these are actual cash estimates of cash payments out the door. So we've got $116 million roughly of hard costs that we have to fund. The other costs to the right are actuarially determined costs and what I'd consider soft costs. So for life insurance, as an example, and bear with me if this is just old hat for you guys, but I think it's important to remember. So for life insurance, active employees and retired employees pay the same rate. They pay a blended rate. And the same is true for healthcare. You pay the same, a retiree is going to pay the same premium to cover him or her dependents as an active employee would. And that's per state law. State law requires us to calculate and collect a blended rate between active employees and retired employees. But we know retired employees, due to their profile, would normally pay a higher premium, right? The older you are, the more you have to pay for life insurance versus a 20-year-old. But because we blend the rates, there's an implicit subsidy there, right? Active employees are subsidizing retirees because we had to blend the rate. Does that make sense? And so the actuary is calculating what the value of that implicit subsidy is. So for life insurance, the implicit subsidy is $582,000. And you see these numbers increasing, right, as the number of retirees increase. So this is an open system in that anyone working for the district, when they retire, can still get life insurance through us, right? So that's why the numbers are increasing. But that is something I don't say we have to fund. I mean, because the retiree is paying their life insurance costs, and the active employee is paying their life insurance costs. It's just at a blended rate, right? So we're collecting the life insurance premiums from everyone. Does that make sense? But the actuary has to calculate the implied subsidy. Because, why? Because they have to as an actuary. They have to calculate it for their actuarial report. I'm going to stop there. Did that make sense to anybody at all? Or do you have questions about, you want me to repeat myself what I'm trying to tell you? Does that make sense? Kind of. It's a kooky calculation.
So, Mary Lamont, so this is money that's 91,000, basically, is money that,
Where are you?
at the bottom of life insurance?
91 million.
Yeah, I'm sorry,
Okay, you threw me on that. There's no number that small. Okay.
million, thousand, what's the
Yeah.
difference?
Yeah.
Is money that we are not putting out.
No.
We are taking in
It,
as
we're not
people that have life insurance are paying into this system. We don't have to come up with 90 million.
correct.
Okay. Or
Correct.
172
Correct.
million or
Correct.
added together. Okay.
Correct. Now, so what, if you take just one number, so let's take 2024, that life insurance subsidy of $582,000. That's the difference of what retirees are paying versus what they'd pay if we didn't have a blended rate, or what their costs would be if we didn't have a blended rate, right? So 582,000 is the amount that we're under collecting from retirees that active employees are subsidizing. Does that make sense? So it's just again, it's a difference between what we collect versus what we if we didn't have a blended rate, what we would collect from retirees. It's the amount of the subsidy. And same on medical, on the next column. Those are that's the implicit subsidy if a retiree wants to cover their dependent or even themselves. They're going to pay a lower rate than they otherwise would because, again, we have to blend rates per law. Now, to confuse matters even more, the district could fund those subsidies and pay our health insurance fund those subsidies, right? Like if we said, well, rather than deem active employees for that subsidy, right? Let's pay the health insurance fund that subsidy. I guess we could, but then I've got to get it from somewhere in the budget, and it's right. We would net the same, right? I'd have to collect it from somewhere else and give it to the health insurance fund, and so the district would be net zero, right? That probably confused you. But these are, the bottom line is, again, these are on the right, soft costs that we don't actually have to fund because we're collecting those premiums from active and retirees. Mr. Kirsch, does that make sense to you?
It does make some sense. I'm wondering about the life insurance. The life insurance subsidy goes to the people who retired before 2006
No, it goes to
and to everybody else
yes.
who retires.
That's why you have active employees shown in that chart.
Okay, and then that calculation, is that part of what the law is that you have referred to?
It
that
is
has to,
yeah, it's a reflection of the fact that we can only charge a blended rate to retirees. We cannot charge their true cost to retirees. We have to charge them the blended rate of the whole universe of active plus retired employees.
and that is set in stone?
Yes.
Because it's when the people turn 70, it cuts in half.
Yeah.
And then when they expire, the payment isn't out of here.
No.
It's-
No, that's right. The life insurance company would pay out then. And that's not shown here. No, that's not shown here. These are premiums only.
And does the life insurance company change from time to time?
It can and probably has. I don't know when we last changed it, but it can.
Okay.
Yeah, we go out and get quotes on insurance and try to get the cheapest insurance we can.
And then our medical claims net of contributions,
Yeah.
that one includes the employee and the employee's family if they choose to take it?
Again, based on the blended rate.
And then the family members, I think, are stopped at age 26?
Yes.
Okay. When we...
Children, not spouse, but children.
Yeah,
are cut
children.
off at
But they
26.
pay for the spouse if the spouse
That's
is
right.
part of the system.
That's right, but they're getting the blended rate for the spouse.
Okay. Yeah, well,
So
it's a lot of money.
it is a lot of money. So why did I have the actuary do this, you may ask?
Well,
Go ahead
because
and
you're
ask.
smart and this is
No.
excellent stuff.
So, I guess what I wanted to test out was, we have $82 million in the bank. And how much do we actually have to fund? Because, like I say, a lot of the numbers you see on the net OPEB liability include what I consider soft costs. So I wanted to strip out, what do we actually have to fund out of this trust? And it's $116 million. We have 81 million. Are we fully funded? No. Kind of getting there, right? Kind of getting there. And so, again, 82 million in the bank for $116 million of liabilities. So we're getting closer. So here's the question I have, or here's the issue that was rattling around my head when I decided to put this on the agenda. We've seen a very bullish stock market, and the higher the funding ratio you have, the less risk, right, you should take, right? If we were fully funded, you would say, I don't want to take a risk of having my assets fall 10% in a correction or 20% in a bear market. Does that make sense? Right? The closer you are to achieving your goal of funding that liability in the future, you want to take chips off the table and expose yourself to less risk. Make sense? Whether you're funding your child's college savings, or you may have a bogey on how much you want to save for your retirement of your own money, right? Think of other examples where you're saving for something, and as you get closer to getting to that number, you don't want to, at that point, you're less risky in terms of, okay, could I afford to lose 20% in a bear market? And so at the same time we've ridden the stock market wave up, which was really good, we're now seeing fixed income yields at pretty high levels, right? 5%. So we're getting close to a fixed income rate of return that's very close to our assumed rate of return for stocks. So does that make sense? So I can, right, our total blended assumed return is something like 6.5%. And yet I can make 5% in the bond market. And so the question is, for this committee, is I think to start to ask yourselves, do I want to take some chips off the table? Do I want to be exposed to the stock market to the degree we are now? If I'm worried about a correction or a bear market in the future, right, then, right, we can see our assets go from 80 million to 60 million, for example. Do I want to expose the fund to that kind of risk if we're getting somewhat close to fully funding these hard costs? So that's the question that I kind of wanted to pose and to get your reaction to. So again, it's a combination of two factors. Again, separating out hard costs from soft costs. And the hard costs are 116 million. We have $82 million in the bank. I suppose part of this is your own sense of the stock market and the bond market and where you think things may go, or how risk averse you personally are or not are. So I know this is a really tricky kind of question, and this is for discussion. Well, no, it says for discussion, possible action. But I'm not necessarily looking for an answer from you today. I just wanted to at least percolate in your head, kind of these questions. I know these are investment questions, and it's incredibly complicated, and, right, it's hard to probably feel too good about any one direction or another, but I wanted to throw it out as a topic of discussion for the committee so that if the stock market did fall tomorrow and we lost 30%, you wouldn't go to your chairman to say, why didn't you ever bring this topic up for us to discuss? So I'm going to stop talking, and I'll throw it out for a reaction from my fellow committee members here.
Jeff Kirst, a question or two. I understand fully the necessity of exploring this. It's, as trustees of the funds, we have to look into this.
And you are fiduciaries, to be clear.
Yes. So we have to look at it and make decisions at some point on this. I still do not understand why the medical claims net of contributions is not a real cost.
Yeah, it's a good question. Unfortunately, I asked the actuary to prepare this. That is their title. That is their heading. And I didn't want to overwrite their terminology. These are really premiums paid. I don't know why they worded it that way. But they did. But I did confirm several times with them, okay, the first two columns are costs that go out the door. These other costs are, again, more actuarially calculated. But if you want to have that discussion with the actuary, by all means, they would be happy to come in and talk about it. Your head will spin as they talk, but that's fine.
I can stand the spinning. It's just that I worry about the people who would rely on this as their medical coverage?
Well, again, we're collecting those premiums from those retirees, and we're collecting the premiums from active employees. It's just, again, this is a calculation of that subsidy of what an older person would pay in premiums versus what they are paying in premiums to the district by virtue of having a blended rate.
For the medical claims.
Right.
The medical claims portion then applies to the 2006?
No, that's why it grows. Well, it doesn't grow. Yeah, it grows a little bit. It's kind of all over the place. No, those are someone who retires tomorrow would be included in this category. They're getting an implicit subsidy.
And that would be a cost, though? That,
Just an actuarial calculation of a subsidy amount. It's not a cost. It's not a cost that's I'm paying someone else.
but it is subsidized
It is a subsidy
from the school district and from the trust.
from active employees to retired employees. It'd be like if we could stratify our insurance rates by the age of our employees. Your 20-year-olds would pay a lot lower premium, right? Because they don't need many services in their 20s. They don't see a doctor much in their 20s. So their medical insurance premium that they would pay would be a lot lower than someone in their 50s. If we said, okay, 20-year-olds are going to pay this rate, 30-year-olds this rate, 4-year-olds this rate, 50-year-olds this rate, 60-year-olds this rate. But when you blend all those employees together, right, that premium is going to be higher than what that 20-year-old would have paid. And that blended rate's going to be lower than what the 60-year-old would have paid, even if they're active. So that's why we say there's a subsidy, there's a cross subsidy within there, right? Some people are going to pay less than what they otherwise would, i.e. those in their 50s or 60s, and some employees would pay more than what they otherwise would, i.e. those in their 20s and 30s. So the implicit subsidy is what, in that case, if we wanted to calculate what's the implicit subsidy for 50 and 60-year-olds, then that would be the that would, right? We times their monthly payment that they pay now versus what they would pay if we stratified rates. Does that make sense? So
It makes
maybe
sense.
they're paying $500 a month for medical insurance with the blended rate, but they pay $700 a month if it wasn't blended. That's a $200 a month subsidy. That's what that number is.
And that one is for the families.
It's both for the retiree or their spouse or any dependents they have. Because they're all getting a blended rate.
Well, current retirees are not eligible for school district health insurance.
I think
That ended, I think, in 2006.
No, they're not. They're not getting they're not getting the PEB subsidy or the medical subsidy, the 40% off. But they still can pay the district rate, as I understand it, to get health insurance.
I don't know about that. I'd like to find
Okay.
out where
All
that
right.
comes from because
Okay, I'll check.
my research, since I'm now old, I've looked into this pretty
Okay.
closely.
All right.
And when you're a geezer, you get your Medicare if you've gotten enough
Once you reach 65.
work credits.
Yeah. Once
You
you
have
reach,
to have 40 work credits to be eligible for Social Security, which is where the Medicare comes from.
okay.
So they get that, and my understanding with a lot of the teachers is that they
Now-
retire before they hit 65. So they've got
Right.
that gap year
Right.
of
Which you
4 or 5 years that people have.
Which you can buy district insurance.
Right.
So that's probably what this
That's right.
takes care of.
That's right. And we do collect Medicare, even though we're not withholding for Social Security. If you were a worker in 1986 or 87, I think you could choose not paying
They
into
could choose,
Medicare.
yeah.
But everyone after 86 or 87 pays into Medicare. We do withhold for Medicare.
So this helps the people who've put in 30 years, but they went to work as a school teacher when they were 22. and they retire at
Right.
50-something. I've
Right.
run into some of them at the Teachers Association, because
Right.
they say they're finished with the classroom, but oh my God, they've got to pay zillions for their health insurance because they haven't hit geezer age for
Right.
Medicare.
And that's-
this is what this subsidy blend would be.
Yes, yes.
That's part of it, right?
That's part of it.
Okay.
If they have a spouse, that spouse is also getting a blended rate.
Okay.
And they're paying 100% of the spouse's premium. But again, it's at a lower rate than they'd otherwise get in the open market.
Okay.
That's why it's an implicit subsidy.
Well, I certainly understand your reasoning about the interest rates,
Yep.
and I would like, and we definitely have to explore that fully. I'd like to get a little more
Okay.
comfortable
All right.
with who the beneficiaries are for our medical coverage,
Okay.
so that we can make sure they're not left out in the cold, because
Okay.
we have an obligation of 175 million on that.
That is the actuarial calculation of that
I-
subsidy. Yes, it is.
Yes.
That implicit subsidy.
And I hate to bring Mark Twain into it, but
But
he had a quote.
Okay. Go,
Can
give
I
it
put
to
it
me.
on our record?
Please do.
Okay, Mark Twain says, there are three kinds of lies: lies, damned lies, and statistics.
Yeah.
And we're working here with statistics.
We are, and it's really challenging to have this conversation because
Yeah.
of the actuarial nature of the computations. I mean, when I started my career, this would make my head spin, just to try to understand what I would consider a hard cost versus not a cost the way you or I would ever understand it in terms of cutting a check to somebody, but
Yes.
instead, saying, well, the district there's an implicit subsidy here, so we're going to quantify that. Well, great, okay, but who cares? If I don't ever have to pay it, why would I care? But they have to calculate.
And then we always have the looming issue of transferring money out of this fund to the district. So the district budgets and whatnot are definitely something that has to be on our mind.
Yeah.
As we think
Yeah.
about what to do to protect the beneficiaries of these funds.
Yeah. I mean, at the end of the day, the district cannot get out of its obligation to pay these PEB subsidies, these medical subsidies in the first two columns. So I don't want to, right? I mean, I think we've talked about that before. It is something
other
the
meetings.
district is liable for. State law doesn't even allow for public entities to declare bankruptcy, unlike California. So there's no provision we could even declare bankruptcy if this became too much to bear. That said, I mean, you're touching upon the nature of my question, which is how best to manage the monies we've collected, and us as fiduciaries are responsible for managing in order to ensure there's money for those subsidies, right? I mean, that's why we exist. It's to manage those assets. And so I think I've talked about it a little, just very briefly before, that we can decide how to invest these monies. You can go 100% fixed income, you can go 100% stock market, you can be an RBIF that has a blended portfolio. We can do whatever we want. And that's why I'm raising it, so that, again, we can have this conversation. We may be at a pivot point in the stock market. I don't know, right? But we can have this conversation, and if you have thoughts or views, we can hear them, and then we can either take action or not. But at least we've talked about it.
Absolutely.
Does that, Mary and Fran, does that make sense to you?
yes.
Because I've been through the roller coaster of our stock market, and I worked for an agency that put all of its money in the stock market right before the big 2001 .com bust. So they lost all that money. Then it took them 10 years, about 7 or 8 years to recover it. We didn't do anything. Then the Great Recession hit, so they lost it again. So I mean, maybe I'm just reacting to that experience to say, I think it's appropriate and prudent for fiduciaries, right, to look at the market and, right? If we need to bring in, consultants or whatever, we can do that, if that helps as well. But just to kind of close our eyes, put blinders on and go down that path blindly, I've seen what can happen, and it's it's really tough. It's really tough every quarter to come in and see how much you lost, and then you lose more, and then you lose more, and it's a tough conversation.
Understood. And I'm glad you brought it up, and that we will push it around and do our thinking and
Okay.
come up with some prudent decisions to try to help the people who are the beneficiaries of
Okay.
these funds.
So what I hear from you, Mr. Kirst, is you'd like a little bit more clarity on kind of definitionally what these items are,
Yes,
confirmation.
that I would like, if that's possible.
It sure is.
And I definitely understand fully your idea of having, well, we had the appreciation of from 20 million to 81 million. Interest rates, we never thought they would go back up to anything that was reasonable.
Right,
Now they are.
right,
So
And-
it's a
and-
flex point.
right. And the question in my mind is, how long do you go without a recession? Right? So we've gone a number of years now since the regular recession. They used to happen every 7 years or so.
Mm-hmm.
And now the Fed kind of plays around and engineers things and pushes that off. But, right, Great Recession was started in 2008. So it's been a long time since the last recession, and I have to say, I worry about it. At some point, we're going to have one, and then what happens? So I'm bringing it up for you to all mull over and lose sleep over. What a lovely Thanksgiving,
Yeah.
Christmas present.
We want to think about it. I lived through the big inflation of
Yeah.
the late 70s,
Yeah,
early 80s.
early 80s, yeah.
And so one of my questions, of course, that I want to mull over is everything I read about is the inflation in healthcare costs. And so that is probably, I mean, it's not going to affect me, but these people who are beneficiaries of this are going to, what if it costs $500 to go to the doctor to just see if your heart is still beating? I worry, that's what I am concerned on the inflation side. That probably is what my big concern is.
Yep.
Mull it over.
Mary or Fran, would you like to see any information? Is there anything that we can provide to help you with this question for our next meeting, which is February?
Fran McGregor, no, I just think we need to have more discussion, like Jeff is saying. And I'm leery about getting too much into this stock market or putting too much into the stock market. It's a little frightening.
Yeah, I mean, again, we go back to the financial statements for RBIF and that table showing their asset allocation.
And we're in the stock market now.
We are in the stock market now.
Everything, right?
No.
I'm trying to, sorry, on page 14 of their financials, that gives you their asset allocation. So we have 28% of our holdings in the bond market, and so that would mean we have 72% in the stock market.
International and U.S.
International and U.S., right. 50.5% in U.S. and 21.5 in international. So, again, that's how RBIF is managed. They're on autopilot. They don't change. They don't consider the unique time horizon or investment horizon of their participating agencies. This is their target allocation for kind of an infinite investment horizon. And you can either go with them or construct your own portfolio.
In one of our prior meetings, we had discussed what stocks they actually buy, and it was an index.
Yeah, it's a large cap index.
What happens to the dividends
They get reinvested.
into
Yeah, into
create the gain?
Yeah, they get reinvest, yes, it's a gain, but they get reinvested to buy more shares of stocks.
And that does not show up as income for this trust.
It does, I mean, dividend income is income, but if we don't withdraw it, it gets reinvested. Does that make sense? It's
In
like
the
your own
index.
portfolio, if you don't take it out, you get dividend, it gets recorded as a return, as part of your return, but if you don't withdraw it, it just gets reinvested.
And what about the bond payments?
Same thing.
Those are just
those
recycled back into
yeah.
new bonds.
Those coupon payments are gonna be reported as income, but they're just gonna be used to buy more bonds
In the index, whatever
in
index.
the index. Yeah, and it's a US Treasury index. It's highly conservative. So it's large cap stocks, it's developed countries, international stocks, and then it's US Treasuries in terms of the fixed income allocation.
And the folks who have their hands on this 700 and some $1 million are the Carson City people that we've read about?
Yeah, they have a chief investment officer. I don't think he has any staff, but their approach is to go into passive index funds.
Okay.
Yeah. And, you've noticed they're not in, for example, I think we've talked about before, they're not in smaller mid-cap stocks. They're only in large cap stocks.
And you said they are not in private equity.
They're
Other things that they have are with
not,
that.
RBIF is not in private equity, PERS is.
PERS, okay.
Yeah. They're not in commodities, for example. It's not in probably a lot of things you invest in. I'm going to guess, but
Well, I'm more conservative than these people.
okay. So yeah, that's the allocation. There's no alternative kind of investments here, or like I say, commodities or other kinds of investments. Not saying we would go into those. I'm just, what you see here is all they do.
This is it,
It's a
yeah.
passive index fund, yeah.
Mary Lamont, so I'm confused if this, on this page 14, if this is kind of set in stone,
Yes?
then what is your question to us?
All OPEB trusts have the ability to not invest in RBIF and to engage an investment manager to construct their own portfolio.
Okay. But it would still be this?
No, you could say, I only want to be 33% in stocks
Okay.
and 67% in bonds.
Okay.
That's what I'm
So that's
asking.
a big risk we're taking, not so much in the stock market, but it's a risk of going away from where we are right now?
Well, yeah, I mean, it's not a risk necessarily, it's just saying, all I'm saying is 72% of our money is in the stock market, either domestic or international stocks.
Right.
And are you, again, given the fact that we've accumulated 82 million to fund 116 million in liabilities, non-discounted, are we comfortable with a 72% allocation to stocks, which is fairly aggressive, right? Are you comfortable with that allocation, that asset allocation, or would you be more comfortable, again, maybe pivoting to fixed income, where now you see 5% yields? 3 years ago, we saw 0% yields. Now you see 5% yields. Is that for the risk return, are you more comfortable getting 5%, which is a little lower than our assumed rate of return for stocks, but basically riskless, right? Do I take 5% riskless, or do I have this blended portfolio of 72% stocks, 28% bonds, and take the risk? That's what I'm really asking.
Well, and then at 5%, the money doubles in 12 years
Right.
at a 5% rate.
Yeah.
Less whatever has to come out to pay the fees for
Yeah.
the retirees for their different the medical things.
Yeah. So I'm glad you're asking the question, because that's really the question. Are we comfortable with that asset allocation, or do you want to take a less risky posture, given the funding levels we have? And again, I'm not looking for a quick reaction today. But I think we put it on there for possible action in case there was some vote of some kind that you wanted to give direction for. But I'm not hearing it today. I hear some questions, but that's the question. Are we comfortable with this allocation, or do we want to de-risk at all and lock in a 5% yield? Because that's really what's available. You can lock in a 5% yield.
But then we're running the risk of tomorrow it goes up to 10%.
Yeah, you could,
Yeah,
right,
I mean,
you could
any
lose
of it-
out.
yeah,
Yeah,
any of it is-
you
yeah.
absolutely can lose out.
It's all one big risk.
I mean, right, there's no guarantees here. Yeah, there's no guarantees, and
Just so you see, posted online, it doesn't show for action.
wow, okay, well, we won't, thank you, Andrea, we won't take an action. I don't think we had an action, but we won't take it. I don't know. Okay, what happened here, I
And
guess?
that's the one posted online, I just.
Yeah, we'll go with that. All right, so I think we beat that one to death a little bit, but you get where, I think where what I'm asking.
Absolutely.
So with that, we'll close item 2.07. I know. 3.01, our next meeting is February 22nd of 2024. We won't do this meeting over again because then your brain would really hurt. And then item 3.02 is closing public comment. Thomas, would you like to opine on the stock market at all, or no? Okay. All right. Seeing no public comment then, our meeting is adjourned. Thanks for your time. Appreciate it.